Now, residual income and economic value added, these are some points that were never fully explained to me, and I'm going to explain them to you super simple because you don't really need to know the high theoretical nature of high and mighty, right? Educational PhD level explanations here. What's residual income? It's basically profit. It's basically profit. It's a little different, but net income, what did you make from this project or whatever you did, minus the required return. So this is essentially break even, right? Required return. We've mentioned that in a few other lessons. Your required return is essentially your break even. So what is the money you made over your break even? You could also tie this similarly conceptually to contribution margin. It's got some similarities to it. There's just a lot of formulas throughout this whole exam that are so dang similar. It's kind of wild. Economic value added is essentially the same thing, right? It's the same thing. We'll talk about the differences. I have here, it's actually the same formula. Let's talk about here. This is the income. So talking about both of these that a business will continue to earn after the income producing project is completed. Any profit earned past the required return is residual income, right? So this is just extra money in your pocket. The longer this project goes, the more money you'll make. Once you've broken even, it's all good. It's all profit from then on. The only notable difference between residual income and economic value added, or EVA, is that residual income is calculated on net operating profit before tax, whereas EVA considers the profit after tax. So what is this? This is before tax net income. This is after tax net income. That actually is the case a lot of times. There'll be so many formulas where it's outflows and inflows, but one formula is considering tax, the other is not. Just memorize that. That's the only difference here, right? It's profit after break even, but this is not taking into account tax. EVA is considering tax. It's profit after tax. The basis of these measures is to identify how effectively the company utilizes its assets. And why would you want to use both of these? Well, not taking into account taxes is more focused on you internally. It's more focused on your company. How well are you doing? And then, obviously you do want to take into account taxes because that's real money that's being paid out. So they both have their place. You want to use both of these if you want to determine how well your company's doing. Sure, all of you are going to start, if you want to, you're going to start your own companies, do well with them, take what you're learning here and just make a lot of money. Just give me a shout out whenever you're making your millions. Residual income example. Let's take a look at an example. Well, we've got a fruit company. Apple and banana are their two segments. So do they make apples and bananas? No, they make furniture. Who knows what they actually do there, but it's a fruit company. Yep. Apple and banana are the two segments, and they have financial information provided below. So the required rate of return is 8%, meaning you have to make, say, a 8.1% return in order to be above break even. Hopefully you make more. Hopefully you make 9, 10, even 50%. That would be lovely. Okay. What is the company's residual net income? Let's see. We have operating income and total assets. And what are assets? Well, you could really just view the assets as the invested capital, right? The outflows. It's what you had to put into each segment. We'll follow a formula, and net income is, well, it just gives us operating income of Apple is 600, banana is 500. So that's pretty straightforward. Now, the required return might be something that gives you a little trouble. And just to give it to you in the formula sense, how do you get your required rate of return? Sorry, your required return? Well, you take your rate of return, multiply it by your total assets, and that gives you your required return. Now, let's talk about why that is, because this is, again, it's your outflows. It's your invested capital. You multiply that by what you need to make from it. That gives you the required return you need to make on these assets, again, in order to break even. That's what this all is. As such, it's 600 minus, well, we get 96 here, 500 minus, and we get 112 here. This gives us residual incomes for each independent segment, and then add those both together. The total residual income for this fruit company is $892. That's all it is. Some people view this as super scary, and hey, I did too when I was studying, and that which I studied with was not explaining it to me too well. This is all it is. Nothing too crazy. Just memorize it and you'll do super well. Now we have economic value added. We've got the following information provided for Chiefs Inc. Now you see a tax rate here, and why is that? Because we're going to take into account the tax rate. However, if we had a tax rate for the residual income, we'd ignore it, right? We'd totally ignore it, and that's fine. Now, what is that company's year-end economic value added amount? Same formula relatively, right? It's your profit minus your outflows, but minus your required return. Obviously, this takes into account taxes as well. And how do we do this? Well, first, let's just take into account taxes, get that out of the way. So we want our inflows. We want our 500 operating profit. We subtract taxes. 35% of 500,000 is 175. So we knock that out of the way. 500 minus the taxes we're paying. Our total profit post-tax is 325. Great. Now, your required return. Okay, I don't see anything that says required return or is hinting at it. However, let's use our information and knowledge that we learned about capital structure. Well, your required return is just your break even, right? And what's another break even metric? I mean, it's WACC. So weighted average cost of capital equals required return. That's the same thing. Because this is the cost, the weighted average of cost of borrowing money or just raising money. And that's break even. So if you can make more than what it costs for you to borrow it, you're golden. You're doing well, right? I love making these connections. Hopefully this might be a light bulb moment for you. Maybe you knew this already. Just WACC is the same as required return. So boom, we just do WACC. We bring it all together. We don't have preferred stock here, just equity and debt. It looks like we have 50-50 equity and debt. So $1 million of equity, $1 million of debt. We have our weights, and then we have our costs. Now it gives us the after-tax cost of debt, and as we know from learning this in capital structure, if it didn't, we would just have to do 1 minus the tax rate, all of that good stuff there. We'll multiply the weights by the costs, and that gives us a WACC of 9%. Great. And just as we did to the previous question, what's the required return? Well, presumably we're using this total $2 million to buy assets, to invest. Otherwise, why are we raising it? And why are we even considering it? So this is $2 million of assets purchased. 9% of that total invested capital, right? Debt and equity, again, presumably buying assets, gives us $180,000. Same as we did for residual income. And economic value added, here we go. Boom. Just to recap, it could have said, what is the residual income? You would have done absolutely everything the same here, except you would have ignored this and just used 500 instead of this 325. And vice versa, right? In order to do the economic value added with the information previously in our example, it would have had to give you a tax rate and you would have had to worry about that. So just to bring it to your eyes, hopefully you're enjoying this. It's nice and calming. Yes, the exam could throw more tricks at you. I mean, will it get much more complicated than this? No, but there'll be more tricks in the questions. They'll be trying to mess with your head and maybe make WACC a little more difficult. And you got to think it through. And the best way to do that, just see more examples and you'll be fine.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.